Hi, everybody. It is great to be here. My name is Brian Feroldi. I'm a content creator, financial educator. I've been a writer for The Motley Fool for about 8 years, and I've been investing in individual stocks for about 19 years. Over that time, I have learned a ton of lessons about investing the right way and the wrong way. And the point of my talk today is to talk a little bit about 3 different methods that investors can use to value growth stock. So that will be the primary focus of the presentation. The presentation should take about 30 minutes or so. There is a nice disclaimer here, which I invite you to read if you'd like to. And thank you to OPTO for having me as a guest here. This is a subject that I absolutely love talking about. So here is the time frame for the next roughly half an hour together, along with some rough estimates of how long each should take, and I do want to leave plenty of time at the end for some Q&A. So since the goal of this talk is to educate you about how to value growth companies, I think it's first important to level set and make sure that everyone understands something that I think is incredibly important to understand about businesses, and that is the business growth cycle. Broadly speaking, companies that are successful investments that do come public go through 6 distinct phases in their life as a company. Phase 1 is the startup phase. It's during this period that the company comes up with an idea, and the goal of the company during the startup phase is to really establish product market fit, to introduce the product to the market. It's very common for companies that are in this stage to be losing money because they are plowing all available resources into taking advantage of the market opportunity that they see for themselves. If successful in the startup phase, they then move on to stage 2, which is the hypergrowth phase. During this stage, revenue growth accelerates very, very quickly. The company often starts to generate some positive gross profit. But again, the company is investing so heavily in its growth and building out factories, hiring employees, that it's very common for the companies to be losing money in this stage. If they can successfully exit the hypergrowth stage, they enter the self-funding stage. This is when revenue growth continues to grow very robustly, but revenue and gross profit growth outpaces expense growth. So over time, the company gradually gets towards reaching break even on the bottom line. From there, companies that successfully exit the self-funding phase go on to drive operating leverage. So that's when they focus on profitability above all. After that, they focus on returning capital to shareholders, and hopefully they can be in that stage for a period of decades, as many successful businesses are. And then eventually there comes a time period when capitalism does its thing, that business runs its course, and it goes through the inevitable decline phase. Now, my talk is going to focus mostly on growth companies, and I'm specifically going to focus on those that are in stages 1, stages 2, and stages 3. Valuing businesses in these stages is often very, very challenging. So I'm going to give you some ideas for how we can do that as investors. Now, when thinking through the income statement, what the income statement looks like in each of these phases, here is roughly what investors can expect to see. So in the startup phase, a company has very little revenue. Its gross profit is often very low or even negative. Its operating profit and net profit are all negative. And it's common for these companies to be funding themselves by issuing a lot of shares to investors. So their share count is rapidly increasing. As they exit that stage, their revenue and gross profit start to grow, but they're still losing money. And it's only in stage 3 that they start to reach that break-even point. So again, we're going to be focusing on companies in phases 1, phases 2, and phases 3 that, loosely speaking, have these kinds of income statements that we can be looking at. And the way that you can tell which phase a company is in is by focusing on its income statement and its income statement's trend over time. Now, the reason I'm harping so heavily on this business growth cycle is that there are multiple ways that investors can value businesses. There's lots of different methods that investors can use. And one common valuation mistake is that investors use the wrong valuation method at the wrong time. And I'm a firm believer that the valuation method that you should use on the company depends heavily on which stage of the business growth cycle a company is currently in. Now, this chart that I created is a visual that shows you which valuation method is most appropriate given a company's phase of its growth cycle. And since we're focusing on stages 1, stages 2, and stages 3, the 3 valuation methodologies that I want to focus on for the remainder of the talk are these 3. Total addressable market, the current multiple of a business, and the adjusted multiple of a business. So let's dive into each of those 3 methods in detail, starting with methodology number 1, which is total addressable market or TAM analysis. Now, TAM analysis is most useful when a company is in the startup phase or in the hypergrowth phase. It's somewhat useful in stages 3 and stages 4, but this is not a valuation methodology that you should use in phases 5 or phase 6. So if we come across a company that's in the startup phase, how does TAM analysis work? Well, TAM stands for total addressable market, and that is simply the annual spending, the annual revenue opportunity in a market in which the company operates. Now, the formula for figuring out what this number is quite simple. It's how many potential customers exist in that market times how much does the average customer spend in that market each year. Now, TAM can be geographically concentrated. For example, it's very common for companies in the United States to say our total addressable market opportunity in the United States is X, and that's different than our global total addressable market opportunity. Now, as a quick example, early in my career, I worked for a company that was focused on selling products to people with type 1 diabetes in the United States. Now, our target customer market at launch was about 1 million customers in the United States, and our average customer spent about $8,000 per year in this product category. So if we do that math, our company's total addressable market in the United States at the time of launch was about $8 billion. And if we did a TAM analysis for the entire world, there was about 20 times that number of total addressable market. So our TAM for the entire world was about $160 billion. Now, an important thing to understand about TAM is that markets change over time. It's very common for more customers to go into a market and more spending to go into a market over time, especially markets that are rapidly developing. So the total addressable market opportunity that exists does change as a market matures or, on the flip side, shrinks in value. Now, why is TAM useful? Why am I focusing on this number? The reason that it's useful is it allows investors to estimate the upside potential of a given market opportunity. I'm going to walk through the formula for figuring that out just in a little bit. But before we do that, I want to introduce another acronym that's also useful for this analysis, and that is called what a company's SAM is, S-A-M. Now, SAM is very similar to TAM, except for the S stands for serviceable addressable market. And this is the annual revenue opportunity in the portion of a market that a company is actively targeting. It's a finer distinction between a company's TAM. So again, getting back to the company that I worked for previously, while the TAM in the market we were going after was about $8 billion, we were targeting a subset of that market. So people that already had a competing product. And that was a SAM of about $1 billion. And again, globally, that SAM was about $20 billion. So SAM is a more accurate measure of the revenue opportunity that a company is going after than TAM. But oftentimes companies will give you their TAM and not their SAM. Now with this in mind, here is the equation that investors look at to figure out to use this metric most appropriately. It's the total addressable market multiplied by the market share that company could capture, multiplied by the profit margin that company could have, multiplied by the future price to earnings ratio of that business. If we do that multiplication, what that will give us is the future market capitalization of a company we're looking at, to which we can compare it to the company's current market cap to see how much upside potential we could have. So let's take those one at a time. So the estimated market share that a company has. No company will ever get 100% of its market share. So you have to take a portion of a company's TAM, or better yet, of a company's SAM, and estimate how much share of that market a company could capture. For example, let's say we think we can capture 30% of the SAM in the United States. That would give us a realistic or semi-realistic revenue number of $300 million per year. If we translate that out to the entire world, that would give us a revenue opportunity of about $2 billion globally. So once we have our estimated market share and a more accurate guess at how much revenue we could have, the next step is to multiply by our estimated profit margin. Now, a profit margin is just simply taking the company's revenue, subtracting out all of our estimated costs along the way, and figuring out how many pennies per dollar of revenue we can turn into net income or profit. Now, coming up with this number is, of course, an exercise in guesswork, but we can look at the profit margins of different industries and different successful companies to get a more accurate estimate of what this could be. Now, the average company in the S&P 500 has a profit margin of about 9 or 10% or so. And the industry in which the company is operating has a big influence on what kind of profit margin a company could eventually get to. So if we were in the grocery business, it would be realistic to assume a net profit margin of, say, 2 to maybe 4%, which is what Kroger and Amazon have. Conversely, if we were in the software business or the medical device business, it's reasonable to assume that we could get to a profit margin in the 20s, perhaps. But either way, we need to make an assumption about the ultimate profitability that the company can generate. Now, once we know that number, we just have to figure out what our price to earnings ratio could be in the future once a company is optimized for profits. I'm sure many of you are familiar with the price to earnings ratio, but simply put, it is the company's current stock price divided by the earnings per share of that business. And this number represents the multiple of earnings that the market is willing to pay to value our business. Now, estimating that number is, of course, a bit of a wild guess. However, we can look at other companies in our sectors, as well as the market in general, to get an estimate of what kind of price to earnings ratio we could expect to trade at in the future. Now, once we do all that math, TAM times market share times profit margin times PE ratio, that will give us the estimated market capitalization that our company could trade at in the future if it can successfully execute against its profit potential, its market share potential, and garner a PE ratio. Now, if that sounds like a whole lot of assumptions we need to make, you are correct. TAM analysis, by its very nature, is extremely imprecise. It's essentially back of the napkin envelope math with figuring out how much a business could be worth in the future. Now, this is not an analysis that I like to do myself. However, it is a useful analysis when we are presented with no other information about a company. So on the pro side, this is a very easy analysis to do. It can show us what the upside potential of a business is, and we only need a handful of variables to come up with a TAM analysis. On the downside, it's overly simplified. It's our assumptions can be unrealistic, and that TAM and that SAM number do change over time. But if you're in the venture capital space, or if you're interested in investing in venture style companies, this is the kind of growth analysis, valuation analysis that you can do. So that's method number one, TAM analysis. I'd now like to talk about method number two, which is multiple analysis. Multiples are incredibly useful valuation methodologies, and they're one of the most popular because they are simple to use. Now, again, because we're talking specifically about startup, hypergrowth, and self-funding companies, a really key question to ask ourselves is which valuation metric we need to look at. So first, let's ask ourselves, well, what is a multiple? A multiple is simply a ratio that compares a company's current market value to one of its financial metrics. As an example, a very common way to value a company or the value of a business is its market capitalization. And we would just take its market capitalization and divide by one of its financial numbers to give us a ratio of the value of that business divided by its financial numbers. Now, here's a picture that shows you some of the most common valuation metrics that investors use. The most common one is, of course, the price to earnings ratio. The formula there is the company's market capitalization divided by its earnings on a trailing basis, and that gives us the company's price to earnings ratio. There's also the price to sales ratio, which would be the market cap divided by total sales, or price to free cash flow ratio. So investors like to use different metrics depending on the stage of the business and what they are personally comfortable with. Now, before we talk more about these multiples, it's important to go back to this slide for a second. So remember, this shows us which stage of the business growth cycle a company is currently in. And we are focusing specifically on growth companies, so those that are in stages 1, stages 2, and stages 3. If we think about the income statement dynamics that companies in these stages are going through, there's some things we need to keep in mind. First off, these companies tend to be rapidly growing their revenue and their gross profit. However, these companies are also losing money on an operating basis and on a net basis, and their share count is often rapidly increasing. Given those dynamics, a key question for us to ask ourselves is what numbers on the income statement is a company currently optimized for? Companies in stages 1, stages 2, and stages 3 are not optimized for profit or operating profit. However, they're often optimized for revenue and for gross profit. That's an important distinction to know, because when we're thinking about the valuation metrics that exist, the first question we have to ask ourselves is the company optimized for the number in the denominator. Now, stage 1, stage 2, and stage 3 companies are optimized for sales, and they are often optimized for gross profit. Because of that, the price to sales ratio and the price to gross profit ratio are meaningful metrics, valuation metrics, for us to look at as investors. However, oftentimes these companies are not optimized for EBITDA. They're not optimized for free cash flow. They're not optimized for earnings. So it would be a mistake to look at those valuation metrics to draw conclusions about whether or not a company is a good value or not. So let's focus on that top one for a second, the price to sales ratio, which is a useful metric to look at when valuing companies in stages 1, stages 2, and perhaps stage 3. Now, this is simply the market capitalization of a company divided by its trailing revenue, which is a real number we can look at. Now, multiples are only useful to investors when we have something to compare them to. We can compare that to the company's peer group in its industry, or we can even compare it to the market as a whole. Here is a visual that shows the chart of the price to sales ratio of the S&P 500 over the last 20 years or so. So currently, the average business in the S&P 500 is trading at about 2.5 times its sales multiple. And if you look back historically, this number has averaged about 1.7 times sales or so. So when looking at a company's price to sales ratio, if this number is above 2.5, that means that it's more expensive than the average business in the S&P 500. And if it's below this number, it's less expensive than the average business in the S&P 500. So let's take a quick second to look at Shake Shack. Now, if you're familiar with Shake Shack, this is a fast-growing burger chain in the United States. If we look at Shake Shack's financial statements, we will see that it does not have any profits to speak of. It's not producing any net income. It's not producing any free cash flow. So therefore, its price to earnings ratio is a negative number. But it is growing fairly rapidly. Its revenue growth over the last 3 years has been about 22%. Because Shake Shack is very clearly in stage 3, it's a growth company, looking at its price to earnings ratio or its price to free cash flow ratio is useless. The company does not have a ratio that is meaningful to us. But we can look at this company's price to sales ratio. And doing so, here is what we see. So historically, this company has traded as high as 8 or 9 times sales after it came public and in 2021. More recently, the company is trading at about 2.5 times a sales basis, which means it's being priced the same way as the average business in the S&P 500, even though this company is growing faster than the average business in the S&P 500. That could indicate that this company is trading at a relatively bargain value right now. Now, one tool that we can use that that the company that made this chart, Stratosphere, does is they also allow us to map the company's price to gross profit ratio. So rather than the denominator being revenue, the denominator is gross profit, which is the number right below there. We see that this company is currently trading at about 6 or 7 times its gross profit, which is slightly more expensive than the S&P 500. But by looking at the price to gross profit ratio and the price to sales ratio, I think it's fair to indicate that Shake Shack is not being priced all that expensively, and it might be a value today. Of course, full disclosure, I am not a shareholder of Shake Shack. I have no interest in becoming a shareholder of Shake Shack. This is just for an example of purposes. Now, what are the pros of using multiple analysis on growth style companies? Well, for one, it's very easy to do so. It's just simple division. You can also easily compare companies to themselves, to competitors or the markets. A huge plus in the favor of using multiples is that you have to make no assumptions about the business. A lot of other valuation tools require you make assumptions. You make no assumptions with multiples. It's just division. There's also historic precedents you can look at for that company to figure out if it's a good value or not. On the flip side, multiples are often overly simplified. As we've seen with growth companies, you can't use valuation metrics at all times. And sometimes there are things, one-time events, income shocks, profit shocks, that can cause multiples to also look awry. So there's pros and cons to using multiple analysis when valuing growth stocks. So that moves on to our third valuation method, something that is called earnings power. Now, earnings power is most useful when a company is in stage 3, or it's somewhat useful in stages 2. So in stage 1, the best method to use is total addressable market. In stage 2, that's when multiple analysis becomes more useful. And stage 3, that's when price to earnings power becomes more useful. So what is earnings power? This is a valuation method that attempts to quantify a company's ability to generate profits, not its profits, its ability to generate profits. What do I mean by this? It's very common for companies that are in growth mode to plow all available resources into top line growth. The focus of the company is not expense control. The focus is top line growth. Companies in this stage, as we've seen, often have no profits or even negative profits. So what earnings power analysis does is it asks the question, how much profit could this company generate today if the management team shifted its focus away from growth and focused on profitability instead? So it's a way of visualizing a theoretical income statement using and asking yourself, how much profit could the company generate today if it focused on profits, and then comparing that to the company's current market cap. Now, to do so, to figure out the earnings power of a company, we simply take its current revenue, which is a known number. We multiply that by its potential profit margin, and that gives us a company's earnings power. And then we simply substitute that into the PE ratio equation to give us the company's adjusted PE ratio, or a price to earnings power. So it's a simple substitution of the denominator. Now, how can we figure out what a company's potential profit margin should be? There's lots of ways that we could do this, but one way that I'm a fan of is by looking at peers to see what kind of profit margin they're pulling up. Now, in Shake Shack's case, there's a company in the United States called Chipotle, which is a mature Mexican restaurant, but it's also a restaurant company, so same sector, and it is highly profitable. So if we do some side-by-side analysis of Shake Shack and Chipotle, we can help to estimate the company's profit margin. So here are Shake Shack's current numbers. This is about a $2.4 billion company. It's got about $990 million in trailing 12-month revenue. It's got negative profit margins, and its sales are growing about 19%. Let's compare that to Chipotle, which is a much bigger company, $53 billion market cap. It's trading at it has $9.3 billion in trailing 12-month revenue. However, Chipotle is optimized for profits, and its profit margin is about 12%. So it's logical to assume that Shake Shack, once it focused on profitability, could get to a 12% profit margin. Now, if we just look at these companies' price to earnings ratios today, we see that Chipotle is trading at about 48 times earnings, and Shake Shack is not trading at any multiple of earnings. And again, if we look at the company's revenue and profit margin, an interesting question that is worth asking is, how much profit could Shake Shack deliver today if it had Chipotle's level profit margins? And the answer is about $119 million. So if Shake Shack focused on profits today and was as profitable on a dollar basis as Chipotle, its earnings today would be about $119 million. And if we take that and substitute it into the price to earnings ratio, well, we see that Shake Shack has a price to earnings power ratio of about 20. If we compare that to Chipotle's actual price to earnings ratio of about 48, you could make the argument that Shake Shack is actually much cheaper than Chipotle is today by a wide margin. And this is, again, how we can value a growth company that does not have any profitability as of today. Now, like any valuation method, there are pros and cons to using the price to earnings power ratio. On the plus side, it is useful to use on growth companies. You can compare them to mature counterparts, and there is a historical precedence for doing so. On the flip side, it once again really simplifies things. You have to make a big assumption about the company's future profitability, and it doesn't necessarily factor in the growth of the business. Okay, I just threw a lot of information at you, so let's quickly review what we learned in this presentation. So takeaway number one is that companies go through 6 stages in the business growth cycle, and you look at the income statement to figure out which stage a company is in. Takeaway number 2 is which valuation method you use depends heavily on which stage of the business growth cycle a company is currently in. And you can get into trouble as an investor if you use the wrong valuation method at the wrong time. Now, the 3 valuation methods we talked about were first and foremost TAM analysis, and here's the formula to figure out the upside potential of a business. We also talked about multiple analysis and how you take the value of the business, divide by some financial metric, which gives you a multiple. And critically, the denominator, if you're going to use multiple analysis, make sure the denominator is fully optimized. Don't use the wrong denominator too early. We also talked about earnings power analysis, which is a theoretical exercise into how much profit a company could be generating today based on a precedence in the market. Thank you all so much for your time and attention. I hope this was useful for you.